I'm Susan Phillips. I'm Director of the School of Public Policy and Administration here at Carleton University. PhilanthroTHINK is our thinking around philanthropy and the nonprofit sector that's tied to our master's degree, the first of its kind in Canada, in philanthropy and nonprofit leadership. We have an amazing first cohort of students in that program. And what we're trying to do with the program is not only educate students in the context of regular degree programs that we do through executive format and online delivery, but to engage conversations with thought leaders, with governments, with private sector, around the way in which philanthropy and the nonprofit sector is changing, the way in which those relationships and the intersections between the public, private, and nonprofit sector are changing. And PhilanthroTHINK is one of the ways in which we engage those conversations. And we're going to look this evening at one of the real interesting points of intersection which there is enormous change happening, and that's around impact investing. And no better than our two presenters to lead that conversation. Dr. Tessa Hebb is Director of the Carleton Center for Community Innovation, 3CI, and Executive Director of a new initiative at Carleton, 1125 at Carleton. Her research focuses on responsible investment and impact investing. She's leading a big research project, a 5-year project, funded by the Social Science and Humanities Research Council that has all kinds of institutional partners and a mess of academics involved in it. The 3CI is a leading knowledge producer of research around philanthropy, the nonprofit sector, and particularly social finance and community development. And 1125 at Carleton is a collaboration and innovation workspace hosted here over in the library. Dr. Hebb has her doctorate from Oxford University, and she's been a leading publisher, knowledge mobilizer around this space. You have probably encountered a variety of her volumes, Working Capital, which has gotten extremely good reviews, The Power of Labor's Pensions, and No Small Change on the role of pension fund in corporate engagement. Karim Harji is co-founder and partner at Purpose Capital, where he advises investors, foundations, and financial institutions globally on how to align their investment strategies with their social impact objectives. He's the author of Accelerating Impact, Achievements, Challenges, and What's Next in Building the Impact Investing Industry, that was commissioned by the Rockefeller Foundation. He's co-founder of socialfinance.ca, and best of all, he holds a master's in public administration from Carleton University. We always like to welcome our alum back. To the current students who will soon be alum, keep that in mind. So, Tessa and Karim, welcome, and over to you.
Well, thank you very much, Susan, and thank you to the Masters in Philanthropic and Nonprofit Leadership for the opportunity to come and speak with you this evening. And welcome to everybody who is here with us this evening for this discussion of impact investing and how we're going to build that marketplace in Canada. It's a real pleasure to be able to talk to you about this topic. It's one that I'm deeply interested in, researching and also teaching. And I see a few of my current students are here tonight, so that's terrific. So thank you. Now, basically, the presentation this evening is going to touch on some areas. First, a basic understanding of social finance and impact investing, building a coordinated marketplace and what that's going to take, developing intermediaries who are going to be able to connect the supply of capital with the demand of capital, and the instruments by which one would actually do the transfer of that capital in the marketplace, and then measuring social metrics. That's a key part of impact investing. These terms, social finance or impact investing, have been used kind of interchangeably within this sector. The term social finance was really advanced and is still advanced in the UK. They are much more comfortable with that term, social finance, and indeed in continental Europe as well, than they are with the term impact investing. But as you see, kind of using these interchangeably, this is the active investment of capital in business and funds that generate positive social and or environmental impacts, as well as financial returns. And these can range from return of principal to above market rates. And they return those to the investor. This was a definition that was coined by the Monitor Group in a report that they put out in 2009. And at around that time, we had a lot of activity in this area in the UK under the term social finance. And at that time, the Rockefeller Foundation in particular was very interested in advancing this set of ideas. And they actually invested $50 million into research and activities in this space in order to really advance it. And they, using the groups like the Monitor Group, used and coined this term impact investing. So you can see where those terminologies came from. And they felt that, particularly in a US context, that the term impact investing may have more resonance than the term social finance. As we know, sometimes in a US context, the term social can drive people out of the discussion. And so I tend to think of it, though, very much in the same way that we use the term finance to describe a broad field, and we use the term investing to describe the active placing of that capital in the investment. And so in finance, we use these terms, and I've come to use these terms in the same way, where I use social finance as my broad umbrella, and then the actual act of the investment as impact investing. Now, everybody's always interested in the numbers in impact investing, and when we talk about measuring impact, one of the things that we know is that numbers tend to be very important and to sort of take a hold of how we frame the conversation. And so I was looking for some good sets of numbers, and maybe Karim, when in his remarks, will have some absolutely new numbers, because Karim has been involved in a very major project called the State of the Nation, which is, well, that's not the term of the report, but that's what it's been called in the shorthand for what's going on in impact investing in Canada. So the numbers that I have are from the 2011 Mars report that they framed the Task Force on Social Finance. And at that time, they were indicating that approximately $2 billion was invested in impact investing in Canada, and that was expected to grow to $10 billion by over the next 10 years. Now, Karim can give us some insight into that number because when I was looking at his report, I saw that was a number, the accelerating impact was a number that you use for all of North America, correct? Yeah. And so what you can see is in this task force report, they were really bringing a lot of things to bear on that number. And I've come to think of it as very similar to the way that we describe the not-for-profit sector as being broad when we bring in hospitals and universities and some of these other very big actors in the not-for-profit sector, and core. So I would describe that $2 billion as being broad, and brings in a lot of actors like for example, the community development, the Community Futures Development Corporations in Canada, and some of these other really large entities that are indeed operating at the community level. What's, J.P. Morgan is another source of numbers that help us to understand the sector. And they basically did some projections, and they said that over the next 10 years, it had the potential to be globally a $400 billion to $1 trillion of invested capital in impact around the world. So they were, again, using a very broad brush in terms of what was coming into impact investing globally. And but part of our kind of just talk tonight is, are we reaching that potential? Do we have that coordinated marketplace? Are we going to be able to get the true full potential from impact investing that we want to see? Or are we going to remain in a kind of a niche view with impact investing? Now, well, I've been told by my current crop of students that the word lecture is verboten, and that it's all about dialogue. However, when I'm in dialogue on this topic, I generally like to start with a bit of a theoretical foundation. And one of the reasons why I say I want to have a theoretical foundation when I'm exploring and working and researching in a topic area is that I want to have, much like this platform, I actually want to have something underneath me. I want to have some sort of a platform that I'm drawing on in order to build the framework of impact investing and have a foundation. Now, again, when I'm working with students who are working on things like their PhD thesis, I say to them, try to find a theoretical foundation that has a Nobel Prize winner attached, because then you know that you're going to have something really solid to build on. And unfortunately, in impact investing, we don't yet have that breadth of research. I'll be looking forward to our first Nobel Prize winner in this area. But I draw on a proposition called the blended value proposition that was really expounded by Jed Emerson in the late 1990s. He started to really think about these ideas of impact coming from investments. And you can see that I've provided the definition of blended value. What does this mean? It means that all organizations, whether for-profit or not, create value that consists of economic, social, and environmental value components. And that investors, whether they're at market rate, charitable, or some mix of the two, simultaneously generate these forms of value by providing capital to these organizations. So as you can see, I've put a foundation under impact investing that's pretty broad. Because you could say, well, basically you want to have a positive impact from all investment. Investment that doesn't have positive impact is usually investment that hasn't gone very well. Because you want to have companies that grow, companies that employ people, companies that are vibrant actors in their sector. But the intentionality that sits behind impact investing is what really defines it. So that it's not simply to generate maximum profit for shareholders through a growing entity or company in our community, but to generate all of these forms of value, the social, the environmental, and the economic, which is broader than just the financial return. And so what do we need in order to build up this marketplace with this intentionality behind these kinds of investments? Well, these are the things that we've identified in our research are absolutely fundamental to building this marketplace. You have to have the intermediaries that have the particular skill and expertise that they can facilitate the exchange between the suppliers of capital, who are often philanthropic organizations at this point in time, and the demand for capital, which tends to be in the third sector broadly. The intermediaries play an absolutely vital role, because you can imagine, and I'm very fortunate in the last few years because I'm sitting on the investment committee of the Ottawa Community Foundation. And this has been given me a really unique insight into how do you take something from a policy or a program to be actionable at an investment committee level. An investment committee, whether it's of a philanthropic organization or a larger pension fund or any other large institutional investor, they actually don't want to become an expert in those investments at the community level. They want to have intermediaries who are expert for them. And what you could say here in terms of a theoretical underpinning, because if the investment is a good investment, most finance theory would say somebody's already there investing in it. So if we have a capital gap in impact investing, which we know we do, you know, a standard finance person would say, well, maybe that capital gap is a good thing, because maybe these aren't good investments. But what we know is that the information costs in this market are so high that they act as a barrier. And it's through the intermediaries that these information costs are lowered for the investor, because the intermediary brings their expertise and is able to find those really good deals at the community level that the investor wants to invest in. Now, when I first started working in this area, and I think Karim will remember this, as will Arlene Wartzman at the back of the room. She and I have worked in this broad area for almost 20 years. Oh, she says shush. When I used to talk about intermediaries, you know, in the 1990s, I had to bring forward examples that were from the US, because we had so few intermediaries that could take this role between the supply of capital and the demand of capital, that I would have to point to US examples. As we started to come out of this, and we'll talk about the development of this marketplace, what we started to get first was intermediaries who were also acting as the suppliers of capital. And in many cases, these were community-based credit unions like Van City and other credit unions across the country that both provided the capital and provided the intermediation of the capital to the community. But more and more, what we're seeing is that intermediaries are able to play their true role, which is bringing a supply of capital from investors to the community and linking those with the really good investment opportunities. But again, you can't link if you don't have a tool or an instrument by which to do that. And again, we've had to develop some of these tools and instruments in the Canadian context, and we'll talk a little bit about that as we go forward. What are some of these new tools and instruments? How do you get an equity position in a not-for-profit that's not able to offer shares? I mean, these are challenges that the sector has had to face in terms of how do you develop this marketplace. You may be able to structure some loans into the marketplace as a way to build the market. But as you want to look at more exotic opportunities, those have had to be created in the Canadian context. Often, though, with the investor, I usually say that one of the things that they're looking for is, and this is for the finance people in the room, the plainest of the plain vanilla. They're so a little bit risk averse, including the investment committee of the Ottawa Community Foundation. But so they want to have an instrument that they understand and that they know its properties. And part of what the challenge has been is to develop those very clear, very transparent instruments that are that enable the investor to be able to invest it with confidence. And you'll remember, an investor like Warren Buffett says that if you can't understand the instrument, you probably don't want to be in it. And I believe that he was saying this long before subprime. So those exotic instruments tend to actually drive people away from the market rather than toward it. And then, finally, you need this set of metrics. How are you going to measure the investment? And here, you actually have to measure not just the financial and economic impact, but you have to measure the social and environmental impact as well. Because if you're an investor that is now coming to the market and saying that you want these opportunities, then you have to be able to measure them. And again, about, I don't know, maybe 6 or 7 years ago, and I mentioned this to my class last week, I said to myself, I don't think metrics is something I'm going to have to know that much about. I think I'm going to leave that for my colleague, Ted Jackson, who's very, very expert in evaluation. And I could just leave that area. But of course, what happened is you can't be engaged and involved in impact investing without a solid understanding of how to measure social impact. And so, yes, I was gradually drawn in. Now, the other thing I say to my class is, and I move my watch in front of me, is that I usually don't even get started for at least 15 minutes into the presentation. So I'm amazed at how quickly time is ticking. But this is again from the Monitor report, and I like this chart. It does give a good indication of what are these pieces that we need to build a coordinated marketplace. In an uncoordinated state, you basically have these disruptive innovations. You have people like Bill Young of Social Capital Partners, for those who are familiar, coming forward using a lot of his own funds in order to create a fund that would invest in impact. But you don't have a large ecosystem in which Bill Young operates. You have, as I say, this disruptive innovation. Then you begin to build this marketplace with those key ingredients that I've just described. And here you start to reduce those transaction costs. Again, I think Susan and Karim will remember a very small group that we brought together here at Carleton. I think it was about 5 years ago, maybe 6. And various of the foundation representatives said, we've tried some of these things and it's not worth the brain damage because it takes so long and it's so hard to do one small deal. And you can't operate like that. It was Alan Broadbent of the Caledon Institute, who was in Calmetto, who was bringing that point forward, that it was extremely difficult. But as you start to coordinate the marketplace, you reduce those transaction costs. And then coming to the full market value, you begin to bring the mainstream players in. And we hope that we would be there in about 5 to 10 years. But we're still very much at that early coordination phase. We see some large mainstream players coming into the impact space, like RBC with their $20 million fund. But if you look at 20 million against their total asset size, you can see that it's still really not yet mainstream. And again, these large players are often bringing their community relations or their CSR people to the table, a discussion that I was having earlier today, rather than their mainstream players. And so you can see that we're not at that capturing the full market value yet. And then maturity, and this is where actually you come to a steady state. You start to consolidate in the industry, and this will probably be 30 years from now because we have to move all the way through these cycles before we would get to that point. Now, the demand side is really interesting, and a lot of people have asked me, what do I think impact investing means to the demand side. And we heard a little bit about this in the last PhilanthroTHINK. What's changing for the sector? And one of the things that I say is, we're moving from this giving to investing in terms of the way in which the philanthropic sector is operating. They can be providing a grant, but they're making an investment in the organization that basically says we're not looking for any financial return, but we're looking for 100% social or environmental return for this investment. For the organization itself, they start to make a real shift within the organization. They move from thinking, how can I get to the end of the year paying my bills? And then they start in January again saying, okay, what can we do this year in order to be able to pay our bills? And it's a continual cycle year on year, which really wears an organization down. And I know there's a few people here who come from organizations where they've had to struggle with that. But basically, once we start to talk about assets, remember those environmental, social, and economic assets of the demand side, they start to say not who will fund me, but rather who else values these assets. And what I find is one of the most unique things about impact investing is that it unleashes a kind of creativity and an energy within the organization that they then utilize and think very creatively about how to address their mission through these opportunities. So I think that in many ways, this unleashing of energy, and I love being at conferences where organizations have started to shift their mindset. And it doesn't matter who's come to town. This is a housing organization in St. John's, Newfoundland. And they just started out by saying, well, maybe we should have a catering company, and maybe we have all these units, so why don't we have a cleaning company? And then, well, we need all these repairs on our units, so why don't we have a small construction company? And then why don't we provide jobs for people who are using our transitional housing? And it's just kept snowballing and snowballing. And so when Prince Charles was coming to St. John's, Newfoundland, they said, aha, there is an asset, and we're going to capture it, which they did, and they got Prince Charles to come and participate with them, and they turned out the town, and the whole thing. I was so energized, and it wasn't just the ability of a great Newfoundlander to tell a wonderful story with a beautiful lilting accent. I was just so energized by that presentation, and I thought that's the energy that's unleashed when you start to think not just in this cycle of how can we meet our current needs, but start to think really creatively about what's possible. And then on the supply side, we do see this alignment of mission with assets, and a kind of drive toward innovation that's going on in the sector. And changes to the sector, and the new generation of investors that's coming. And I must put another bullet under this slide, though, because it's not just high-tech billionaires in the U.S. who have driven us toward impact investing. It's not just the Zuckerbergs and the Gates and the Giving Pledge, et cetera. But it's also things like crowdfunding, ways that individuals can give $5 and $10 in order to get an organization or an idea up and off the ground. So all of these innovations are being unleashed in terms of the supply side of capital. This, again, is another figure from the Monitor report. And here you see this intersection between those who are seeking high impact and prepared to take lower return, and those who are seeking higher financial returns but would like to see some impact. And those are kind of two types that are operating in this sector, and both are very, very important. So that usually in the sector, those on the demand side, they're looking for those impact-first investors. And often if they're offered a market-based deal, they say, well, boy, I could get that down the road at the financial institution. But because they are often looking for those below-market opportunities. But both are quite important. And I'm currently working on some research where I'm looking at the infrastructure asset class as a way to bring those finance-first institutional investors to come and invest more in community. I think that that's vitally important. But I've come to understand that the small scale of some of those investments at the community level is probably unlikely to draw in our really biggest investors who want to have these much bigger deals. Now, this is the impact investing continuum, so you can see the asset classes that are available at both a below market and a market rate. I often tend to focus on the guarantees that sit between those below market and market rate investments, because I think that's a good space for government to operate in. The reason that I think that is that many of the benefits that accrue from impact investing actually come back to society as a whole. And those are captured by government. But in addition to that, the risk that's embedded in these investments is usually wrongly priced. And government's able to provide a guarantee that lowers the risk for the investor, but that where the default rate in actual fact is incredibly low. And we know that from quite a bit of research in these areas, that the risk is too high, is perceived as too high in these deals. Now, I've pulled out from the internet, full warning, because I've got a Community Forward Fund slide, some of the great impact investing opportunities that we've seen in Canada in the last few years. The YWCA in Toronto put together a brand new building, of which I believe 150 units in the building. It's on Elm Street, so prime Toronto real estate. And 150 units are at the affordable end of the scale. Now, I had a call from Lois Fines, who's the CFO of the YWCA. And again, that was about 7 years ago. And she phoned me up. She said, I've heard that you're somebody I should talk to about where I get $12 million. And I said to her, Lois, there's something I have to explain about academics. We're long on the talk, short on the money. So, let me help you strategize, and let's think about where you can get the $12 million. Because, of course, they had good first mortgage funding from, in this case, Infrastructure Ontario, at the unheard of rate of 1.3% on their money. So they got a very, very good deal. But then they had to have that last piece of capital that closes the gap. And they were very fortunate that they were able to raise that capital in Toronto and close the gap, and that building is there today. And this impact investing space is not just in Canada; it's also around the world. And many people, particularly in Europe, see impact investing actually as a vehicle for the developing world. And they're surprised when I make presentations that are very domestically oriented, because they're used to seeing this frame around microfinance, around things like the Deutsche Bank iFund, and various other tools and instruments that have been used for development in a global sense. Now, we need these new legal structures. We need these new sources of capital. I've already talked about guarantees and credit enhancements. We're seeing more and more of these in Canada. We see the British Columbia and Nova Scotia have both brought in a new Hybrid Companies Act. So again, I don't have to point to the UK and the US. We have community interest companies in British Columbia that are going to enable social enterprise to register as a hybrid mission-driven organization that's still able to offer share equities for equity investment. And this is really important because sometimes you don't want a loan. Sometimes what you actually need is a long-term patient equity investment that's going to help the organization in its need for capital. Now, I've actually pulled some examples of intermediaries from across the country. Again, my list gets longer and longer all the time. The Cape Fund is one that's dedicated to investment in Aboriginal businesses. Community Forward Fund are many of our credit unions. The Fiducie de Chantier de l'Économie Sociale in Quebec. Resilient Capital, which is based out of Van City in Vancouver. These are all new intermediaries. They're actually still, in many cases, developing their track record, which, again, for the finance people in the room, you'll know is vitally important to have a track record in order to show success of these intermediaries. And this is my Community Forward slide. That is from their website, and this is their investment in the museum that enabled this group to get some bridge fund financing in order to be able to expand and grow their business and utilize some of their entrepreneurial ideas. So I'm going to do what I do in my class and just stop at my allotted time so that there's some time for Karim to talk a little bit about some of the things that he's been working on and to kind of give me some argument for some of the things that I've stressed are vitally important. I'm just going to go to my last slide. Yes, you can see I tend to go on. But basically, these are the challenges. Those high transaction costs, because we're still in this uncoordinated marketplace, and it's still incredibly difficult on a case-by-case basis to do many of these deals. The lack of information, the lack of market responsiveness, the connection between performance and capital allocation, the lack of common standards and definitions in the field, the lack of intermediation, though that one is changing, and the lack of this understanding of the risk and the returns that are in the structure. And by that I mean the mispricing of risk by placing it too high, which is a barrier to capital. So Karim, I'm going to leave those challenges and look to you for a response.
Great. Well, thanks, Tessa, and it's great to see so many people out here. Susan, thank you for the introduction. It's always great to be back at Carleton. New building, new classes, see lots of people that are looking to make social finance a career. And I know when I was here, I guess it was, 7 or 8 years ago now, this stuff is really just coming on the map, and I was pretty fortunate to have both Ted Jackson and Tessa, there, I think, really at the forefront of a lot of this stuff here in Canada. Now I would say Carleton is still leading the pack in terms of social finance, impact investing, and responsible investing, and no small part to Tessa's work and Susan's leadership. So thank you all for coming. What I'm going to do is just put a few things out there around impact investing. Not necessarily challenge Tessa, because I obviously agree with everything she said. She taught me a lot of what I know. So we can't duke it out here. Maybe we can later. We'll see. But I'm just going to put a few more thoughts around how do we take impact investing to the next level. Tessa has really talked about some of the foundational elements of impact investing, why it's exciting for a whole bunch of different reasons, why it's a need, and why there are opportunities, particularly in the last slide, for a lot of groups to be able to actually address those challenges. I run a firm called Purpose Capital. We're set up to address those challenges that Tessa had on the last slide. We think that there's lots of capital out there that's seeking both financial return as well as social return. We think there's a lot of great opportunities that could benefit from capital as well as other stuff. But the gap is in the middle, this information asymmetry gap that Tessa talked about. So I'm just going to put out about 8 themes. I'm going to go through them really quickly. I've got 10 minutes, so 1 minute per slide. Just to provoke you guys also to think about how we take this to the next level. So I'll start by just a little bit of an observation and then almost a bit of a challenge. So the observation here is when we think about impact investing today, for the average person, we still think about the little small social enterprise that needs a loan to make it to the next year or two, or potentially an entrepreneur that has a fabulous idea that's going to provide drinking water to some, village, and then they need an equity investment of, $20,000. Impact investing, as you've heard from Tessa, is much broader than that. And how this is being manifested today is we still think in terms of transactions. We don't think in terms of portfolios. And so, again, the challenge here is how do we move from transactions to portfolios? Today, some of the investors Tessa was referring to in foundations, they're still struggling to make their first investment. How do I do it? They spend a lot of time and effort. For me, the bigger question is how do you look at your entire range of assets that you have, 100% of them? And how do you deploy your entire portfolio of financial resources, of human capital towards impact? And that's probably a challenge for universities as well. This is just a couple of diagrams just to look at. When we look at portfolios as well, you're optimizing no longer on two dimensions. So it's not about risk and return, but it's also about impact. That makes things much more difficult, but also opens up a whole set of opportunities. In impact investing, you tend to hear about how much money people are making and how much good they're doing. I think the big untapped opportunity, as Tessa said, is how does this change how we view risk? The whole financial crisis was really a mispricing of risk, or using our traditional theories to try and address a phenomenon around risk that actually wasn't reflective of reality. And so for me, impact investing provides a really neat set of opportunities around how to price risk by taking into account a broader range of factors beyond what we build into our traditional quantitative models. So that's one challenge. And again, if you're inclined, we can get into that in the Q&A. Second challenge, or second opportunity, is how do we make it accessible to everyone? Today, impact investing, is really not accessible to the average person. If you've got a lot of money, so you're an accredited investor, that's when you typically have access to these opportunities. Or if you're a pension fund, you've got a lot of money, you can find ways to deploy it. I don't know how many of you have gone into your bank and asked your advisor, I want to make an impact investment. If you have, anybody here done that? What do they say? Exactly. That's what they say. What? And then when you try and tell them, well, okay, I'll come back in a month and try and figure this stuff out for me, they actively discourage you because they say there's no track record, there's no product, blah, blah, blah. Some of that stuff is true, but it's not nearly as true to the extent that they're talking about. You now have financial institutions. The first image is from Van City. They're a $22 billion organization. Most Canadians haven't heard of them. And I think that's kind of sad. So, we've got a $22 billion organization whose mission it is to align capital with values. We all should be doing that. The second group is called Triodos. They're based in Europe. Again, their whole mission of the financial institution is to be transparent around where money goes and that it goes to communities. They make a lot of money. They're pretty well known. So I think that one of the things, again, as a challenge to the field is how do we make this accessible to all of us? In a couple of years, in 5 years, each of us should be essentially banking in a way that reflects the way we give. Today, we think about causes that matter to us, and we say, great, at the end of the year, this is what I'm going to do. Well, why don't we do that about our banking? We're beginning to do that around our shopping in terms of saying we're not going to shop, if materials look like this or, they're made somewhere where we don't agree with the labor conditions, et cetera. We should be banking that way as well. Third one is to recognize the multiple dimensions of scale. And this is an interesting one in that in our field, Tessa touched on this as well, and many of you who know social enterprise or social finance, we're obsessed with this concept of scale. It's like, if only we could get to scale. At the same time, I think in a very insular way about scale. It's about that one organization that could be the next Google. Well, we've got the equivalent of Googles here in Canada. There are pension funds. The top 10 of them, these are figures from 2011, they control $714 billion. That's a lot of money. It's probably gone up since then. $400 billion of that in 2011 was in Canada. Again, that's a lot of money. They made an additional $240 billion from 2003 to 2011. That is one interpretation of scale, measured by a financial number. Again, how do we take this kind of concept around that we do have scale in terms of finance and take it to the scale of the opportunities that we're trying to address? We think about global warming, hunger, any of these issues. there's been attempts to actually price how much it will cost to feed everyone in the world. It's actually much less than that. So I think when we think about scale, we have to broaden our horizon and look at multiple levels of scale. And also, an interesting point is that scale is almost, I think it's quite subjective. People define scale in terms of numbers often. But if you're living in a village, scale looks something very different than if you're living in a city. If you're concerned about a very local problem around poverty, it's a very different level of scale that you have to address if, compared to if you were living in a city. Or we're thinking about a different issue like healthcare or education. Those are massive problems, but if you're concerned about your local catchment area, it's a much easier problem to address. So I think when we talk about scale, it's not just one word, it's a whole series of concepts. The other thing, again, in this space that is interesting is this idea of a trade-off. In order to do good, you have to make less money. In order to make more money, you have to do less good. And I think to an extent that's true or has been traditionally true. Today, I think that's changing. Zipcar is a classic example of how financial and social returns don't necessarily move in the same direction or are not at opposite kind of ends. Zipcar, you'll see on the right, that's from their website. They say that, they obviously care about making money. That's obvious. But they say each and every Zipcar takes 15 personally owned vehicles off the road. So they actually measure how, if more people are actually using their cars, there's less cars on the road. Generally, hopefully, that's a good thing for society. People are using transit and all that. In this case, the more successful they are, the greater the environmental impact potentially they're having with less traffic congestion, et cetera. You're seeing many more of these business models focused on the sharing economy. And there's some other examples in the boxes where people don't necessarily have to buy stuff. You can rent stuff and rent it around how you're using it as opposed to just renting it, not using it, and throwing it away. Your footprint's much bigger in that scenario. So again, impact investing is quite interesting in that you don't necessarily have to sacrifice a financial return if you want to be good or do good. And I think that's also what's different about this space. Another point, particularly probably interesting to a lot of the students in the program, what does impact investing mean for philanthropy? There's one of the big worries in the space, particularly from the nonprofit sector, that says, if we all begin to talk about investment, what happens to the grants? We're doing mission-aligned work, and often, you can't monetize everything, so what are we going to do? And I would say that philanthropy and impact investing must always coexist. There's certain things around that philanthropy can provide for, and there's other things for which you can actually build investment into. The most exciting part is how you use the best of both to achieve social impact in ways that we're not doing today. So one way to do that, there's a really interesting publication that was published by Monitor and the Acumen Fund, which looks at the case for philanthropy and impact investing. And the central premise is that you can use philanthropy in really innovative and creative ways to actually begin to create markets for which there weren't markets before. But also, in certain cases, you can use philanthropy to actually test out ideas to provide better outcomes to people when today they're not, those outcomes don't exist. And so the central message here is that it's not an either or. I think this trade-off mentality is premised on a zero-sum game. When we talk about impact investing, it's about a positive-sum game. We're trying to grow the entire pie of vehicles and tools to address social issues, as opposed to saying we're going to take away from philanthropy and deploy towards investment, because it should be pretty clear that you can't really monetize or create a revenue stream out of everything or every social issue. I think many people should agree with that. Another premise, we talk a lot about investment and impact investing. The impact is equally important. This isn't just your average everyday, I'm going to make an investment and hope it does some good and not a lot of bad. We have to be much more intentional about setting the bar high on impact investment. There's already some talk around saying, well, is every investment an impact investment? We're creating jobs, people's lives are better, and I would disagree. I would say what makes this different is that impact investing, both investors have an intention to generate social outcomes, as well as the investees. And we need to hold both of those actors to a high standard on the social outcomes. And so, as Tessa mentioned already, there's a lot of activity around measurement. It's pretty fragmented right now. There's a lot of tensions. There's no generally one accepted way to do that, and I think that's okay. You know, this is a period through which the field is going through a lot of experimentation, and it's actually should be seen as an opportunity for a lot of you to try and come up with a way around addressing them. Because if nobody's figured it out, well, maybe you could be that person. So, or Tessa's class. Right? You have to have the Dilbart cartoon in there. I used to do consulting, and that's what we live by, right? There's not that many consultants here. Nobody laughed. Better. We do need leadership in any field to get things done, but you know, we've had, I think, quite a bit of leadership in this space. You know, Tessa mentioned the Rockefeller Foundation. We've had several groups here in Canada that have been leaders. We're at a point in this industry that the slide that Tessa showed around where we are in the industry evolution, where we actually just need to get things done. You know, this is a very exciting concept. There's a lot of exciting examples. How do we actually go from the same 5 examples we always use, we know them all inside out, right, to 100, to 1,000. And that's what I think the field needs in terms of what the next phase of impact investing looks like. And so not only do we need good leaders, I think we also need to be able to just understand how to translate some of these great ideas into practice and talk about, you know, where stuff is working, where it's not, and to be honest with ourselves. And I think the best kind of hopefully ending point around this is just we also have to manage expectations around what we're going to actually achieve. We can't set the bar too high, but also not too low. This is a really exciting set of opportunities, and one way to actually fully realize their potential is to make sure we're honest with ourselves around what's working, what's not, and what really gets screwed up when we think about these ideas, because there's going to be all of them. But the nonprofit sector, as we've heard, is already in its own transformative phase. Things are changing. Let's actually use some of these tools and approaches to realize the potential for what capital can actually bring to the social sector. So I'm going to stop there, and thank you guys for listening.
Thank you, Tessa, Karim. We said at the beginning we do mean these to be conversations, so we have an opportunity to ask questions, to comment, for Tessa and Karim to duke it out if there are points of agreement. And we know that our students and former students are not in any way reluctant to speak their minds, even among faculty, or especially among the faculty. This, the PhilanthroTHINK series is partly sponsored by TD, and we've been a very good partner, which allows us to videotape and therefore share with a broader audience. And therefore, when you have a question, we'll ask you to identify yourself and to use the microphone so that we can record that as well, and so that the entire room can hear you. So, questions, comments, discussion, the floor is open. Yes, please, if you don't mind.
Hello, I'm Deepak Dave, and I was privileged to have a chance to speak with Tessa and Karim in a separate meeting earlier today. Just a couple of observations, and I'd be interested to hear their thoughts on this. One of those has to do with risk tolerance. The risk tolerance of the supply side in philanthropic capital is always going to be finite and at the lower end of the spectrum, because it's a fixed corpus of funds that are often granted to these institutions. They have to preserve that above anything else. That's often the fiduciary duty. So they may have a theoretical degree of risk tolerance that's very separate from their real degree of risk tolerance. That doesn't often meet the social finance demand side, where a lot of projects are beyond the pale of what traditional finance will actually fund. So there's a fundamental mismatch in the degree of risk that goes into the demand side and the supply side. I get the fact that the pricing may be mispriced, but there's still two very sets of duties and requirements. And so often the demand side will come to the table saying, we have an idea that nobody else really believes in, but we think it's going to have an impact or isn't going to have the financial returns that might be demanded. How do we convince you to give us the money to support this? And the supply side would love to hear the idea, except when it really comes down to nuts and bolts and handing the check over. At that point, they realize, wait, we can't risk the amount of money we have. And I've seen this happen in action a number of times. and hence the spinning of wheels that was talked about, or at least implied somewhere in there. The second is that when we talk about government guarantees, I had the misfortune to work for a government organization that actually handed out guarantees during the financial crisis and the Canadian Action Plan, if I recall correctly, that's what it was called. And a lot of foreign banks that had exposure in highly risky sectors in our economy at corporate level immediately converted their branches to subsidiaries and headed directly to our offices rather than to their actual financed companies and said, how many subsidies will you give us? Because immediately what they did was that they played the regulatory arbitrage game to essentially cream off and to boost their returns on equity during the crisis, hence making the operations in Canada look substantially more profitable than their operations anywhere else in the world. I understand where the government guarantees fit in. I handed out a few of them, and so I have no fundamental issue with these, except we have to accept that when this happens, we're trading off a probability of impact in the social finance space with a certainty of profitability for global finance. And I'd love to hear where sort of you land on that ethical spectrum, as somebody just suggested I should call it. Thank you.
Well, those are two very very deep questions, but I'll just give a kind of surface response to each one. The first is these notions of risk, because it is very true that for most philanthropic organizations, they have a firewall that exists between the granting arm and the investment side of the foundation, and that's that divide is quite well known, and so within mission-based investing, or as Karim said, where you're going to utilize all of your assets as far as possible to advance your mission, you do run into this firewall, this divide, because most investment committees have already developed a set of policies and investment guidelines that say that they do indeed want the organization to exist into perpetuity, and in order to do that, you have to make a certain amount of financial return. So this is a challenge, because in Canada, our legal framework around program-related investments is much more restrictive than we would find in a place like the United States. In the United States, you can take more risk through program-related investments that are a real hybrid between the granting arm and the investment arm. And you can experiment. You can have instruments that just return principal, or ones that are returning more. In the Canadian context, the restrictions around program-related investing means that you can only a foundation can only give one to a qualified donee, which is another charity. So that automatically takes out a huge swath of social enterprises or other not-for-profits that aren't registered as charities, and so the restrictions around that vehicle mean that something has to be packaged in a way that an investment committee would feel that it's meeting its due diligence in order to take on. And I'm going to tie your first question to your second question, because in my role in the investment committee at the Community Foundation, I was asked what I thought about social impact bonds, which many of you may have heard about, this idea that that an investor would invest in a bond and it would receive a financial return if the organization achieved a certain level of impact, and that the bond is paid by government. So I, under my fiduciary duty hat, I said, I don't think those bonds are going to be able to be floated in Canada without some sort of a government guarantee, because I don't think that the investor is going to take all that risk as to whether the organization achieves its impact. And we already know from Australia that they've had to offer a government guarantee in order to bring investors in. So I said, let's wait. Let's see if they offer a guarantee along with the social impact bond, and that could meet our fiduciary duty. So, there's a lot of innovation that's going on in the sector, and a lot of ways in which these new kinds of instruments and approaches are able to lower the risk. Because the mismatch on the risk appetite is that the opportunity, the risk has to be lowered, because I don't think the investment committee is going to suddenly gain a greater appetite for risk than what they already have. And so I'll turn over to Karim.
Okay, so those are some great questions. They will require a lot more elaboration, but let me give you just a couple of points on each. And I'm going to speak, I guess, from the angle of someone who's actually involved in transactions and working with investors, as well as, on the other side, entrepreneurs, to think about some of the practical realities of what these mean. If we think about this issue of capital preservation, this is one of the main themes for investors now. I think the challenge is really, how do you develop a set of products that align with what investors are looking for? Because when we think about the misalignment, today you've got a whole bunch of capital on offer that's really looking for a certain set of opportunities that maybe aren't structured in a way to generate the kinds of returns, in terms of capital preservation or security that it's looking for. And that's really where good intermediaries would be able to find the problem and address it. On the question of fiduciary responsibility, again, Tessa has done more work on this than I have, but I think there's a case to be made for a broadened definition of fiduciary responsibility that is completely consistent with impact investing. I think that people would, if we go into the mainstream finance community, they would think that that's still way far off and maybe counter to actually what fiduciary responsibility means. But if you think about what the average pension fund should be looking at, long-term time horizon and a much more holistic sense of what returns they're getting and why. I think the and why question for me hasn't been necessarily addressed. And so I think, we've seen fiduciary responsibility being interpreted in a much broader sense in other countries. I think we're seeing a desire to set some precedents around how to do that. And again, Tessa could probably tell us how to actually get there. That's the work she does. On the thing around being risk averse and risk tolerance, today a foundation basically is happy to give away money, and it's like a negative 100%. So if a foundation today had a choice to say, well, if we can give a loan, and let's say we lose half of our money, but we're able to double our impact, dollar for dollar based on what we were happily giving money away, I think that's a discussion they at least must have. Today, I don't think that they understand the true potential and power of the range of instruments they have at their disposal. And risk is also quite narrow for a lot of foundations. And so I think if they're looking at grants, I know it's coming from separate pots of money, there's a case to be made that foundations need to be incorporating risk in a much broader sense than they are today. I think really the challenge is the costs of doing so are still quite high. A lot of those are really around change management as opposed to the technical processes by which you would do that. Today, any grant making and investment committee, they wanted to, can decide to sit in the same room and have that conversation. If you have a good leader in place, that is already happening today. So, and maybe I know you want to jump in.
I do.
I
I want to circle back on the question of guarantees, because I've already put it out there as I believe a good tool, a good instrument, but we know that it's got a lot of moral hazard that's embedded in it. And it actually reminds me, Deepak, of when I was doing my master's degree, and I was doing it at the Kennedy School at Harvard, and I knew that I was wanting to pursue this area of finance, and so I did half my classes over at the business school, at the Harvard Business School, and every day in our capital markets class, over at the business school. The night before, we would read our case, and we'd be all prepared on it. And every single morning, after reading the case, and it was usually some piece of public policy that had been implemented somewhere in the world, and the professor would start every session with, okay, how are we going to make money today? And there was this absolutely single-minded drive that any time a public policy had been put in place, there was a way in which you could make some money on it. So I say that, but one of the things about the moral hazard that's embedded both in tax credits and in guarantees is that one of the things, when they operate at a community, at a very local scale, you actually are able to avoid some of that moral hazard because people are looking each other in the eye. And they know where those investments are going, and they know how the portfolio, local as it may be, and I see Doug is nodding his head. So in many ways, these community-based portfolios actually overcome some of the moral hazard that's embedded in either a tax credit or a guarantee. And then the biggest issue for me, the biggest question that comes out of that is this question of, so basing in the local is both this strength in terms of being able to deliver on the intended outcomes of the policy, and then an immediate weakness because you can't take it to scale, because you're immediately deeply embedded in the community. And I think it's something that we have to really tease out and think about as we go into looking at these kinds of instruments going forward.
A great first question that put a whole variety of issues on the table. What do we say to investment committees to change some of the thinking? What's the incentive? What's the policy role? What's an appropriate policy response? I wondered how long it would take to get to social impact bonds, and not long is the answer. So let me take a couple of questions, and if you want to comment on what others have said, certainly please do so as well. So, Tina, over to you.
Hi, Tina Krause, Women in Leadership, Ottawa. I think you've whet the appetite of the audience here for you two to duke it out, and so I'm hoping I can provide something, because I'm going to ask you to guess. In terms of accelerated movement and impact investing sector, I think people would say that it used to take, to put a $10 million fund together or something bigger, it took about 10 years. So I'm wondering now, if somebody wanted to put a $10 million fund together, how long you think it would take?
$10 million fund in Canada will be under a year.
Tessa?
Yeah, I think depending on its structure, that it shouldn't take that long to put a $10 million fund together. I would cite the Community Forward Fund as a good example of, I didn't say 10 million. I said a good example of growth rate. That the projected growth rate for putting the fund together has been much, much faster than was anticipated even 12 months ago. And so, again, it speaks to having that transparent instrument that allows investors to see what they're getting into and to feel comfortable with it. So I would say under a year.
Karim, counter?
Well, so I agree.
Give me a city too, though.
A city?
Give me a city in Canada too.
Toronto, obviously. Center of the universe. It has to be at the center of the universe. Well, let me preface that. So last year, and up until I think last year, people were still thinking about how you create a $10 million fund. If you look at the economics of it, anything under 20 million will not actually essentially make you money. So right now, the average fund size keeps going up. If you look internationally at some of the impact investment funds, the average size is easily above 25 million, so 25 to 100. In Canada, we're a bit lower, but today, just why I replied so quickly is I probably see an average of one person a week who's going to set up a fund or planning to do that. The average fund size is no longer 10 million. It's about 20 to 25. And so I think in the next couple of years, you'll see more of that. And again, it depends on where in the country, what sector, et cetera. But I think those are good signs for this space, in that people are now thinking about, well, not only can you raise the money, which I think there's actually lots of money, but there's a pipeline of opportunity to fill that gap. And so both of those things are good indicators of, maybe I'm being too optimistic.
And I'll counter your Toronto. I won't counter it with Ottawa, but I would counter it. I will counter it with Vancouver.
Okay.
Because particularly with this new hybrid company act that's going to allow for equity to flow more easily, there should be a greater appetite to put these kinds of funds together. And Vancouver just sort of gets it.
They do.
Great, thank you. Thanks. Let me take a couple questions, and then you can line them up.
Hi, Peter Linkletter. I'm past chair of the board of the Ottawa Regional Cancer Foundation and a Carleton grad. Thank you very much for putting this on. This has been very exciting thus far. We're looking to social impact financing, social impact bond, maybe specifically, as a way to scale up our existing cancer coaching program. We are very pleased to be one of the 15 highlighted responses from the federal call for concepts. And so, of course, that gets us enthused. We've been doing some sort of outreach with Mars, not the planet. And, of course, in the speech from the throne, there was a line in there saying that, and we're going to do some more stuff. You mentioned guarantees, which kind of got to my question of how important really is it that the federal government or the provincial governments really get their act together quickly. So I guess my question comes around to, as an organization that might be looking to such a tool, specifically a bond, what might we be able to do to help either influence or we've been thinking about, well, geez, could we be an intermediary? And I was pleased to see you've mentioned that there are organizations that are sort of coming out as being intermediaries. But so how close, kind of like the last question, how close are we to being able to actually say, okay, great, there's going to be a social impact bond offering. We do feel that our cancer coaching, the key of it being getting people back to work sooner, would have a ring that either federal government, insurance companies, et cetera, would get interested in, and we're working on measures around that. But I was just trying to get a sense from your perspective as how close might we be to actually having let's call it a guaranteed social impact bond.
Okay, while you think of that, let's take one other question. We'll certainly come back to that. Thank you.
My name is Anu Bose, and once upon a time I was an academic in the UK. My question is something that came out of having been on the board of a small lending institution. There is a tendency to conflate risk and uncertainty. One I can see is quantifiable. Uncertainty is very difficult to quantify and even more difficult to manage. So I was wondering whether there is something that you could contribute to this dilemma, please.
Andrew?
Hi, Tessa. My name's Andre. I'm actually one of Tessa's students, and I'm in the Philanthropy and Nonprofit Leadership Program. And so my question for you might sound like you might have heard a little bit of it before in one of our classes, but my question is, the Ontario government under Kathleen Wynne decided that they would enter the social finance market. And so to fund their $50 billion transit and environmental plan, they are going to be introducing green bonds. And so my question for you is, I want to hear your opinion on such a relevant subject and where green bonds fit in on the social impact and investment spectrum, and how you feel about them. Are you in favor of green bonds? Are these a good thing? With $50 billion that's to be invested, it seems like it could create such a huge splash in this marketplace. So I just want to hear what you thought about it and get some material for my essay, hopefully.
This is a preview. Well, as you can imagine, the class is very lively, and we go, from the clock starts and we just go for 3 hours, and it's great. Shall I lead off?
Sure, so you've got green bonds, social impact
Oh,
bonds,
I
the role
know.
of government, and then this question about what's the difference between risk uncertainty and how do we deal with that?
Really interesting, Peter, that where'd you go? That you brought that example of the Cancer Foundation, because I met with your executive director and we talked about what were the possibilities and the options around a social impact bond for the services that the Cancer Foundation is offering, particularly this coaching service. And I'm a bit agnostic about social impact bonds. I'm not really sure how I feel about them. This was made evidence when I was asked by Evan Solomon's team to go on Power and Politics, and one person had recommended me for the pro side, and the other person had recommended me for the con side. And they phoned me up and they said, "Are you a bit confused?" But basically, the jury has been out for me about how effective these bonds will be, because my worry is that government would pick organizations and targets that are just designed to be met, and in which case, why would you pay investors, 5 or 6% on top of that? Why wouldn't you just give the money to the organization to meet those goals? So that's why the jury's out. But when I heard the description of the services that your organization offers and the possibility of that being attractive as a bond, I've actually used it now as my example of where I think this kind of instrument could work. Because in this case, you have to have your stakeholders, whether it's insurance companies or Ontario Health, they have to kind of buy in with you that what you're able to deliver from that coaching service is going to lower their costs. And the example that you have really does provide that, and also it's a service that's not currently provided. So what do I think you have to do? Well, I think you have to approach, I don't know what they go under, Health Ontario or the Health Ministry. And you have to find somebody in the ministry who's able to champion this for you, and who is like-minded, probably somebody who believes in coaching, this idea of coaching for cancer patients so that they take control of their own health, as it were. You've got to find somebody person who both is really committed to the idea of what service you're delivering, and willing to run with the model of the social impact bond. And we know in most cases when you're trying to advance an agenda within a large organization, you have to find that champion. And many times it's the champion within that structure. Because if you can get the Ontario Health Ministry to back a bond for you, I believe that you will find investors, whether it's in the Ottawa area or broader, who will come and invest in that bond. But without the Ontario Health Ministry, you're not going to be able to advance it. So that's the question on those kinds of bonds. And then on green bonds, well, I think Kathleen Wynne was basically very clever and seeing an opportunity. As we discussed, is there really much difference between this green bond and any other bond that the province offers? If the province puts out an offering, most people, institutional investors step up, individual investors step up, and they buy that provincial bond. The rates of the bond were not much different than a regular Ontario bond. But what you have is an intentionality behind the bond. It's going to come in and fund public transit, and hopefully it will bring a few new investors to the field. It will be used for the purpose that the funds are raised for, and it raises a general awareness of social finance and impact investing, again, in a totally, well, not totally, because, you know, provinces can go down, they haven't, but a fairly risk-averse product. So you could say, yes, you know, we're going to buy some of those Ontario green bonds and put them in our portfolio. And as an institutional investor or an individual investor, you're not taking any more risk than any other Ontario provincial bond. And that's kind of what I mean about an implicit guarantee or an explicit guarantee that sits behind that kind of an investment. So I see it as positive. I don't know, Karim? And we'll come back to the risk and uncertainty.
Yeah, I'll start with that one. So thanks. I think I generally agree with a lot of what you've said. On the green bonds, again, to my earlier point, I think the whole idea of raising the bar on impact is going to be particularly appropriate for this instrument. I mean, green bonds have been issued globally, you know, hundreds of millions into billions of dollars. They're a tried and tested instrument of mobilizing capital at scale and being able to deploy it. Often there's intentionality on both the investor and the investee. In this case, I mean, that would be my bar to say, you know, to what extent is this different from any other bond? And is it? You know, are they committing to reducing the environmental footprint of some of these investments relative to what they might have done? You know, is that the green in the green bond? And are they measuring that? And then on the investee side, you know, where's this money going in ways that, you know, is it in projects that actually look different? You know, is it going into making the actual transportation grid much cleaner, much more environmentally friendly? If that's the case, then sure, I'd buy it. But TD, for example, put out a report, I think a couple days after this, that said, you know, this is great. Make sure that we are helping you underwrite it as well, because, you know, this is what they do. And they have done successful issues in many countries for the World Bank. And so they would be a very logical partner for this kind of thing. At the same time, they cautioned against greenwashing. And I think that that's a really important message for us to say, because if everything is now a green bond or a green investment or a green piece of clothing, it really is going to lose its meaning. And in some cases, some of this stuff has. On the social impact bond, on the SIB example, not knowing a lot about your organization, some of the questions I guess I would ask are, you know, are you demonstrating your impact today? And to what extent are you actually capturing some of those outcomes, as Tessa was mentioning? You need to also be able to compare your outcomes relative to what is already taking place within the system in order to actually prove some of the cost savings. And you need to prove that if you were to actually pull this off, that would be due to your intervention. Because there's a whole bunch of other things that could happen that could reduce the overall rate. But that's part of the payment plan here. You have to also show as an organization that you have the capacity to do this. This is often the biggest barrier and why organizations like yours would work with intermediaries to bring pieces of that equation that they may not have. So whether you do this in-house or with a partner, that would be a question that you know, should try and answer. In terms of the scale opportunity, you know, how big could this be? And what is it relative to the size of the problem? You know, are you addressing 1% of the problem or 90%? I think that, again, from an investor perspective, is particularly compelling. And I would just do one, or give you one caution in that don't think about this as almost like the tool before the issue, right? Think about what issue you're actually trying to solve. And think about whether, like, what range of tools are available. Because, for example, if what you've just described is as compelling as you describe it, and you're able to tell me, look, in 5 years, investors will make their money back plus 5%, you know, I'll be able to make the lives of 20,000 people better, I could probably direct you to an individual who could fund that, you know, with less hoops and less issues than you would going through an entire government process. That's part of the reality of this market, in that, you know, you want to look at your objective as opposed to the tool, and think about the range of tools that are available. And the good news is that there are many individuals who would happily fund something like that, and foundations, perhaps with less strings attached. At the same time, I think you need the legitimacy of government for certain things in order to scale. So it's not an either or necessarily.
Well, one last question with Artem, and then I have a question for you.
I'll just try to keep my question very simple and succinct. I appreciated very much both presentations, and the part that I really was more attached to was that shift in mentality of organizations, from organizations that are beneficiaries to organizations that are actively participating in impact investing. However, there is one particular aspect I'm interested in, the organizational development and organizational capacity and the learning that goes with it. What are in your perspective, some of the challenges that actually organizations face in terms of their capacity to manage? Because the shift in mentality is sort of a feel-good concept, but when it comes to learning on the ground and the organizational restructuring and management, it is a completely different thing. So that's it.
And we're very close to time. I think the other two things that this audience is probably interested in is if you had one thing to recommend as a public policy response, what would that be? And secondly, what do you actually disagree on? Is there anything that differentiates your perspectives on this? And I'm conscious of time.
Okay, shall I lead off?
Yeah. Well, maybe I can answer that last question hopefully very quickly. I think this is a general thing is around incentives. Today in the nonprofit and for-profit sectors, organizations are incentivized in certain ways. They don't always relate to mission accomplishment. You know, in the private sector, it's fairly easy to know what the bottom line is and whether what you're doing is going to make that bottom line better or worse. In the social sector, we tend to optimize on multiple dimensions. And so for me, the way to address that is to actually change the incentives within organizations, you know, all the way from leaders through to staff and processes to actually move in the same direction around mission. For me, that isn't happening, particularly within the nonprofit sector, but also in the for-profit sector. To build a social mission within it, you can actually incentivize that behavior in a way that makes you money, as I talked about a little bit earlier. So I'll think about the policy response while you can jump in, because you probably have an answer to that.
Well, two things. First, really quickly on that question of risk and uncertainty. I think that's quite a profound two different sets of areas to analyze, and it actually draws, for me, it draws much more on my work broadly in responsible investing as opposed to, the kind of intentionality in investment. Because in responsible investing, you're bringing environmental, social, and governance factors into your investment decision making. And for quite a number of years, that was framed as a way in which one hopefully was going to generate some outperformance. But more and more, it's seen as a way to mitigate risk and over time to try to lower uncertainty, because uncertainty is temporal, and we never unfortunately have crystal balls so that we can know for sure what's going to happen. But we feel that if you raise company standards around environmental and social and governance issues, you're lowering some of the uncertainty you face over time. So that just a quick one on that question. Sorry, Susan. And then back on the learning. Well, I would say one of the ways that the it's incredibly frustrating for organizations at the present time, because they're so resource starved that and their lack of core funding means that they're just scrambling almost at all times, and now we're going to add another layer to their already well overstacked plate. I would want to come to the learnings really through the metrics question, because as you start to measure and think about this idea of how do I think change actually happens, and do my activities actually lead me toward that change, and what is happening because of those activities. And instead of seeing metrics as the end of a process by which you report to a funder, you start to see it as a cycle in terms of your own planning and learning as an organization. And I say this even about myself. I mean, I'm run off my feet morning till night. But I should probably be measuring whether all of those activities are actually effective in creating the positive change that I'm seeking. And it's true of all of us. And I think that's where a lot of the learning happens, because you find out that, oh, I thought that activity was creating change. Instead, it was another one, and you learn from that. Okay,
Very quickly,
my,
we need
my,
to wrap up.
my recommend. Well, I'm going to stick with my original policy prescription, which is to lower the risk that's inherent in the mismatch in the sector. And but I don't want to have just a blanket guarantee that Deepak is going to exploit in his banking days. What I want is that guarantee maybe embedded in pools of capital with first loss reserves, but that enable the capital to flow into those locally and community embedded pools of capital to be deployed. And I also know that first loss capital is a great way to incentivize additional capital to flow into those pools. And we've seen that in the Chantier in Quebec. They had $36 million, and they used it as a first loss capital pool, and they currently have, I believe it's close to 70, so they've leveraged at least 1-to-1 in terms of additional capital that's come in. So that's
Karim?
my policy prescription.
Yours, briefly?
So clearly I had stellar training in policy here, so I could write a really long response, but I'm not going to do that. I think the most interesting thing for me would be if we were to mandate, for example, you know, when you walk into your bank and they ask you all these questions around risk and return and you know, how long you're going to live and all of that, if they could actually ask you what you care about and embed that into your investment decision making, I think that would basically open up a whole bunch of other opportunities, because then financial institutions, intermediaries, et cetera, are all going to take that data and build products out of it. Because today the biggest issue is that a lot of those banks basically think that all of you don't care. And so nobody asks them, or if you ask your advisor, they don't give you a response. That doesn't filter back up. So if there was a mandated way, and I think they're doing this or beginning to think about it in Australia, to actually embed that within the Know Your Client process, I think that would actually unlock a whole series of changes around incentives again. So, and I don't think we actually disagree on much, but maybe that's a bit of a bias. So
We'll have to save that for a second conversation. Thanks to all of you for joining us, and Tessa and Karim, thanks so much to both of you.
thank you.
Thank you, Susan.
And please keep posted for future PhilanthroTHINK events. Thank you.